Testing, testing. Yes, yes. All right. This is our last day together. So today is just review. I'm gonna finish up the crypto stuff. Again, it's just review of old topics, but applied to a new asset class. I guess you can call it that. And then hopefully, I guess the main takeaway, of course, is to hopefully convince that you should be careful in this space. The finance stuff that we learn, for over a century of finance innovation and so forth. This the same kind of theoretical foundation should still apply to even new asset classes. So if you learn stuff from your CAPM class, from your put call parity, your option pricing, all that stuff should still be relevant. And therefore, pricing Bitcoin should be no different because it's just another asset class. There is really nothing, I guess, new under the sun is my takeaway. And so you should just be careful if you decide to invest and speculate in this space. All right, so last week I kind of hopefully gave you some food for thought when thinking about how to price Bitcoin returns using the UIP. And then we plugged in some variables, right? And we tried to back out what's the implied adoption rate, essentially, right? Given in the long run. So if we already know the monetary policy of Bitcoin is going to be 0% growth eventually, actually very soon. And at that point in time, really, Bitcoin is now no longer growing, and the miners are just making money from transaction fees. And so really the price, if there is anything that's going to be driving the rate of return from Bitcoin, it must come from adoption rate. And that's where this this percent L that we saw from our lectures, right, a few weeks ago. So plugging in those parameters, our inflation rate, of course, a little bit higher. I think inflation is like 5%, 4 to 5% in the US. But even with those numbers in place, we see that the adoption rate is growing month over month, almost basically or still around 20%, right? Which is ludicrous. So the question is which part of Bitcoin history is most accurate and not a bubble? That's hard to tell. But using the whole history of Bitcoin, it seems like the adoption rate is extreme, right? As far as I can tell, I don't know any goods or service that's specific to Bitcoin, right? I don't know. Maybe you can tell me what goods and services are only priced in Bitcoin. If there is a large sector of an economy that's priced only in Bitcoin, then I can imagine L being quite positive. But otherwise, this is kind of ludicrous. All right, so we can of course move on to something a little bit more macro instead of finance. We can look at the quantity theory of money, which basically says that price is proportional to uh, how frequent money is used, right? So what we have here is the equations that you've seen before. So M times V is money supply times velocity. That's basically telling you what fraction of the money supply is being exchanged in the economy. And then we have the price of Bitcoin, which we want to know. And then Q is the average transaction volume in USD over a period of time. So this number we can get from data from websites. This number M times V can also be extracted from information from the blockchain, the Bitcoin blockchain. And therefore backing out P is quite simple. So I'm going to give you some resources to show you where to get this information. So M times V you can get from this website. So you can click on it. It's in BTC volume. So this is the total number. You can think of it as like the average block size across a month or a day, maybe. Let me see what I wrote here. A period is 1 day. Yes, over a day. So over a day, the average transaction size is around 857,000 Bitcoins as of April 2020. I don't know what the numbers look like, but I imagine it's maybe not too far off. If you look at the transaction volume, total transaction value across the day, uh, the average from 2020 and looking back is around 460 million US dollars. And so backing out the price of Bitcoin, you simply divide, the right-hand side Q, MV divided by the right-hand side Q. So that's very easy exercise, right? It's just the ratio here. And we get that the price of dollars in terms of BTC is 0.00018. And if you want to invert it to get the price of Bitcoin in terms of dollars, we get some lowball number, right? $540, which is at the time I made this slide is, a vast difference between these two numbers. 540 versus around 7,000. It doesn't make any sense. So the conclusion here is that there's something that's not quite right with what's being quoted in the markets, right? The exchanges. The exchanges, it seems like it's to be uh, the source of uncertainty or unknowns, right? We don't know whether or not the price is accurate. Of course, there are several exchanges, and really there's only a handful of exchanges in the world that's actually regulated by a government institution, right? We have the SEC in the US, and then we have the whatever the SEC version in the UK, but everywhere else, they seem to be totally unregulated. So nobody has any clue whether or not the trades that's going on in these exchanges are actually real, right? Are they real? Are there actual people making these trades at these numbers, at these prices? So maybe you've heard of BitMEX in Hong Kong. That exchange, I believe, is either shut down or the owner has fled because obviously he conducted like fake trades on these platforms. And anyways, that's an indication, right? This space is really the Wild West, unregulated. So you have to be careful. All right, so I want to talk about whether or not Bitcoin is a bubble. And this is not just about Bitcoin, right? This is also about other asset classes that you can imagine, like gold, tulips. If you studied, um, uh, that's like a prototypical bubble asset that is talked about during class and finance class. So I want to give you some characteristics of what bubbles look like. All right, so bubbles tend to look like the following. This also applies to real estate. Okay, maybe you guys look at real estate numbers more than anything else. So things are typically considered a bubble if they're limited in supply. I think that's quite obvious. Bitcoin is also clear that it's limited in supply. The most smallest unit is 1 Satoshi. I forget exactly how minuscule, but again, only 21 million units of Bitcoin that's ever going to be existed unless the miners or the validators change the underlying code, which I don't think is ever going to happen. High volatility just means that the price bounces around a lot. So I guess real estate is less so, but certainly, certainly stocks that have low liquidity and low market cap has high volatility in their prices, and they tend to be most likely to be so-called bubbles, right? If you've been paying attention to so-called meme stocks in the U.S., you see like these weird companies that don't operate in the tech space in the past, like AMC. They have really high volatility, high changes in their prices, high volatility, and therefore frequent changes in their prices. Well, it's because there's lots of speculation, right? And lastly, high trading volume. So this may not be an indication that it's a bubble. Certainly, um, mature assets of legitimate businesses have high trading volume, such as Apple stock. Those assets are highly, they're frequently traded. So it's not really by itself, it's not an indication, but certainly perhaps in a short period of time, like Bitcoin during 2017, you do see high trading volume specifically around news announcements, right? Um, anyways, this is specific to to help miners actually recover computing costs. So as you can imagine, if miners try to validate certain transactions, they get a reward. They want to be able they want to be able to dump their the money that they earn from validating those blocks immediately. And one way to do that is to simulate trading volume on these exchanges, which allows these miners to unload their earnings, so their so-called earnings from validating these blocks. All right, so those are some indications of manipulation in certain markets. Obviously, you can look at performance of the stock as well. So performance of the returns over time as well, like time series analysis. So bubbles tend to take place over assets that has high momentum. So what that means is that there's long periods of trends in which past returns predict the future. Of course, this makes sense because people talk about it. The more people talk about it, then the more people pay attention to it, and then its returns gets amplified. Uh, right, high demand for information, and therefore that leads to high volatility. All right, so these are some characteristics. These things we can test. Some of these things we can test, such as momentum. So let's go ahead and do our typical momentum test that you probably learned in your time series class, right? So if you look at two other benchmarks for returns, we can look at the S&P 500 and look at gold. What we're doing is regressing the next period's return on the current period's return with a constant and the beta coefficient. So assuming you have stationarity, all that stuff, assumptions are true, then we can show that there's serial correlation if beta is significant, right? If it's statistically significant. So if we look at the coefficients, what's interesting is that it's a little bit negative, but the t-stats, of course, are not significant. So what that means is that month-to-month returns don't have any predictive power for the next period, right? So no momentum. It seems like at least at the monthly frequency, there's no momentum going on. But if we look at Bitcoin from since 2000, from 2009 or maybe 2015 to 2020, you see that the beta coefficient is positive and statistically significant, right? So indeed, it looks like past returns does predict the future, and which is an indication that you could make money off momentum, but of course this is on average, right? And the average is perhaps skewed by large swings in the price. All right, so we can look at a little bit more detailed on by looking at the R squared of this regression. So for Bitcoin, the R squared is almost 90%. And what that means is that if you just plot a scatter plot between Bitcoin price and also news aggregation, it looks like the trend line is almost perfectly fit here, right? So again, this is not the R squared of this regression. This is the R squared of regressing the Bitcoin price on Google Trends index on Bitcoin news, right? And what this tells us is that the trend line is almost perfectly predicting the price. And it's so you can see this in the time series here. So this is the Bitcoin price, this is the Google Trends, and of course, if you just want to draw a line to the points, is quite a good fit. So in other words, the price is chasing the news, right? So once there's news announcements of Bitcoin, whatever Bitcoin is, Bitcoin that, people just decide to open up brokerage accounts to start trading Bitcoin for some reason. This is what it's telling us. All right, so that's this is momentum. This is news, pushing the price, right? News releasing, moving the price. And the third dimension we can think about is volatility. And if you really want to see how volatile Bitcoin is, we can compare it to the other benchmarks again. So we look at the S&P 500 and gold, and we can see the number of times. So that's what these numbers mean. Number of times in which the price drops by 5%. Okay. So I believe that's 5%. Okay. And this is monthly. Daily. Okay, so maybe not 5%, it's 0.05%. Okay, so daily. So over the course of this entire history, so I believe this is from, let's see, maybe mid 2010 to 2020, the S&P 500 has only exceeded price drops by once by 0.05%. Gold has dropped 3 times in the course of this entire history. Bitcoin has dropped 194 times. All right, and we can go even further. So 0.05%, not a lot, right? We can go higher. Let's do 0.10%, 0.15, 0.20, 0.30%, 0.25%. Never happened. S&P 500 never happened for gold, but look at Bitcoin. The volatility is huge. 81 times over 0.1%, 0.15%, etc. So if you want to get a sense of the magnitude, multiply these numbers by, I guess, 200 or so trading days, right? That's kind of your annualized return. right? But anyways, just compared to these benchmarks, you can see Bitcoin swings wildly in its prices. Of course, I'm only looking at the negative side. I didn't even show you the positive side, but the negative side should already be an indication of how volatile Bitcoin was or is. Okay, so my concluding thoughts are the following: the term digital gold for Bitcoin doesn't apply because there is no correlation whatsoever with Bitcoin with gold prices. So that narrative that you may have heard for the last 5 years, it's false. Okay, there's no correlation between gold prices and Bitcoin. Second takeaway: all currencies, whether it's fiat or crypto, is derived from its ability to should be based on its ability to buy real goods and services. Right. That's the only reason why people want to hold on to dollars, because with dollars you can buy U.S. goods, you can buy Apple computers, you can buy Tesla cars, you can buy all sorts of things, right? But crypto, I list other cryptos here, right? Bitcoin, this is Litecoin, this is Ethereum. I'm sure there's other ones like Ripple and so forth. I'm not sure what their purposes are, given the fact that all these other global currencies, Hong Kong dollar, US dollar, euros, they can buy all the things you will ever need or want. It's not clear to me what these other digital currencies allow you to gives you access to what. Okay, other stuff that might be, I think, have value beyond these so-called fiat currency. Maybe you can make a case that Bitcoin is more secure because the transactions are very hard to undo. So I can imagine, like, maybe you want to make a transaction that's permanent or semi-permanent, that's very, very hard to forge and counterfeit. Then I can imagine Bitcoin being a good choice for doing that. But again, the reason why you would ever need this is because maybe you're moving money from somewhere that's hard to have access to banks. So maybe you're in a poor country or it's being invaded by another country, you want to move money out. Well, maybe Bitcoin is where you should use it to transfer money, right? All right. Litecoin, it's a faster version of Bitcoin in my understanding, and it does have enhanced anonymity. So remember, each Bitcoin is not fungible technically. Each coin has a history. So if you want to do reverse engineer and do forensic finance, you can. And a lot of times this is what the FBI and the SEC does to find out who are these criminals using Bitcoin to finance illicit things. Litecoin has more anonymity, so it's harder to reverse engineer the history of each coin. Ethereum, people say the future of Ethereum is decentralized finance because of its smart contracts, but again, I have no idea about the space. As far as I can tell, I don't think it means much. Okay, and lastly, XMR. It's really, I think this is the closest you can get to fungibility, meaning untraceable history. So XMR is a little bit uncontroversial, and most exchanges refuses to list XMR to trade specifically because it's untraceable. And if you want to, buy and sell something that's untraceable, then you're going to get the attention of the authorities, like the FBI and the SEC or whatever. Okay. All right. So if you want to, so just punchlines here of characteristics of Bitcoin. Bitcoin is the ledger of transactions. That's the entire ledger. The entire history of all coins that's ever issued on the blockchain is the currency. Bitcoin and other similar blockchains is secure because it has this so-called proof of work, meaning that it's people who use it to make transactions on it assume that it's secure because they trust the chain with the most computational work applied to it. So meaning that you have to have all these computers, essentially exerting computational power to win some sort of lottery and to extend the chain, right? To extend the blockchain. And then the more work that's applied to the chain, the more secure it is, right? That's the big idea. But of course, as I said over and over again, very hard to determine its intrinsic value, right? I don't see a much difference between cryptocurrencies and fiat currency in general, because again, it really depends on your belief in whether or not it has value or not. Just like you believe dollar is not backed by anything today. Yes, that's true. But you still have taxpayers who pay taxes in US dollars. You still have businesses paying taxes in US dollars. you have goods and services being denominated in US dollars. And so dollars does have a value. And most importantly, debt is issued in the US in US dollars. So with all this in mind, that gives the currency value. Cryptocurrency, what is it? No goods and services is purely denominated in BTC or LTC or Ethereum, unless you're thinking about like NFTs or non-fungible tokens, but those are worthless anyways. Yeah, so I can't tell you what the intrinsic value is, and you should think of it just like how would you price the value of gold or any sort of commodity, right? The same idea. It's your expectations or belief whether or not you can sell it at a higher price in the next period, right? There's no cash flow to do discount DCF or anything like that, right? So again, in contrast to the stuff we've been talking about in this class, foreign currency does pay cash flows, right? It pays interest, and because it pays interest, you can calculate, right, these securities using the term structure, and you can come up with the price. Can't do that for Bitcoin. Bitcoin pays no interest, despite what people say. All right. So that's my concluding thoughts on cryptocurrencies, and of course, there is a question. I'll give you a sample question of the stuff I may ask on the other slide. So, do you have any other questions about this topic? So those of you who are looking forward to taking the, for example, CFA exam, they won't test you specifically on Bitcoin, but certainly they will test you the differences between Bitcoin and so-called blockchain technology or token stuff, right? The big difference is that blockchain is the most generic term, but cryptocurrency has that cryptography dimension to it that makes it decentralized, right? Makes it hard to crack, make it hard to hack. Whereas the blockchain in general, you could have central authority to give permission to extend the blockchain, right? So that's the big difference. Okay. So if you have, I'm happy to talk about it if anybody wants to have any other thoughts, but if no other thoughts, I'm happy to move on to today's agenda, which is to go over the final, what to expect on the final exam and go over some practice problems. So I posted these slides, I know during the afternoon, so I apologize if you didn't see it until now. So let me talk about logistics first. So this information should all conform to what you see on AIMS. I guess you have a portal where you see this information. This information is what I got from PDF documents sent by my administrators. So make sure what I wrote here conforms with what you know, right? So the location will take place in 2 classrooms. I don't know which section is in which classroom, so just make sure you know which one it is. It's in this Yung Hall, but in 2 different classrooms. It's going to take place on May 10th, which is a Friday. It will be 3 hours long from 6:30 to 9:30 p.m. And just like the midterm, there will be 9 questions, each with multiple parts. All right, so I hope there's, again, you're familiar with the format now, so just different sets of questions. The points will be increased to 20 points per question instead of 10, because I want to give more partial credits and also make this exam look like it's worth more. All right, so 20 points per question, and it's equal weighted. So that means complete in ascending order of difficulty. Is there a comment? It's weighted. It's on the syllabus. I weight this. So the points are arbitrary, right? I wrote on my syllabus 50-50. So whatever points it is, I'll always scale it by the total score and then reweight it by 50-50. So you have to do the math yourself in your head. I mean, you can do it. The formula is in the syllabus. So I refer to the syllabus if you have any questions on how to calculate your final grade. Yes. Any further comments or questions? So 9 questions, 20 points per question, equal weighted. So it means you should complete the exam in ascending order of difficulty. So do the easiest ones first and then move on. All right, so this is what you want, right? You want to know exactly what's on the exam. There'll be 1 question on macroeconomic accounting. So that's just definitions. Do you understand the definitions? Do you know how current account is calculated? Do you know how that's related with savings and investments? This is like a freebie question for you. But this is an important concept in this class, so that's why I have it on the exam. there's gonna be one question on foreign exchange determination. So this is CIP, UIP, purchasing power parity, even arbitrage pricing, right? That's like a cornerstone of this class too. So the first, I don't know the order. I forget the order, but just be confident that there's two questions that's basically on topics that you saw during the midterm. Okay. 3 questions on AADDXX diagrams. So it's just extensions of their midterm model, right? We introduced what AA represents, the financial markets, the DD represents aggregate demand, and then now we have current account targeting with XX. So the additional question I may ask you is, what's the final equilibrium points with reference to the current account target, and what can the government or central bank do to achieve the target, right? Or whatever it is, right? These are the kind of questions I could ask. So just be prepared for that. So there's 3 questions of that, and then 3 questions on FX derivatives. So these derivatives entail swaps, right? Currency swaps, futures, options, forward contracts. We'll do some questions, of course, today. But again, it's not about FX pricing. It's about risk management. So don't think I'm going to ask you about pricing formulas or anything like that, or proving anything. I'm just going to give you a setting, and then you're a risk manager. You're trying to pinpoint exposure to risks they're given a certain conditions, such as price ranges you want to be exposed to fluctuations or risk, and you try to build a portfolio to match that risk that you want to be exposed to. That's the idea. And then one question on cryptocurrency. So this is just multiple choice or true false, and then if it's false, you say, you explain why it's false, that kind of stuff. Again, it's just a superficial knowledge about your understanding of how Bitcoin works, what's the difference between Bitcoin and blockchain and tokens, and why it's secure, right? All right, comments, questions on the topic. So if I do my math right, that's 9 questions, right? So okay, so I'm gonna try something different today. I'm gonna try to allow you to engage a little bit if you can. I haven't tried this before, but I want to be able to work with you on these questions, and then we'll work together on it. But I need to use this website. And I'm going to share it and start a session. So maybe I'll call it 5143, and then let me show you the link. So that you can join. Okay, that's a big, it's longer than I can imagine, but maybe you guys can try it. So try to join that room. Maybe I'll post it in the Canvas. All right. I'll post it on Canvas. Um, maybe I can just maybe do this. Maybe this is easier. Okay. Okay. Much easier, right? All right. Try that. Let me know if you can get in. I hope you can, because otherwise it's just me. It's gonna just be me talking about these questions the whole time. Uh, maybe I'll try to log in my phone just as well. Yep, I think it should work. So that's a GIO, right? Yeah, yeah. You can see I can see your movements. Hold on, let me see. All right, so this is please don't vandalize. So don't like don't draw inappropriate things. Um, okay, so this could go horribly wrong, or it could be interesting exercise. All right. Um, so let's try to work on certain things, these questions together. All right, cool. Yeah, yeah. All right. So let's do the first question. So let me tell you what you should think about first, okay? So I'm gonna write some information here. So number one, there's gonna be a price shock, oil price shock. So that means that P star over P is going to be impacted. Is going to be impacted. But note that we're comparing. Okay, that's fine. Oh, maybe there's too many people. I don't know. So let me read you this first, okay? Let me explain first what you're gonna try to do. I want you to work with the A and DD and XX schedule. Based on this news article that I found okay, that I found a few days ago. It's called Russia's invasion of Ukraine has sent energy prices soaring. So I want you to analyze that news announcement about oil prices rising. And we're going to be comparing two countries, the US versus another country that's less dependent on oil. So here I give you the example of Iceland. So Iceland is not dependent on oil because most of its energy comes from the volcano. So maybe you didn't know that. Now you know. So obviously, given that fact, P and P star are going to be impacted differently. The reason because oil-dependent countries will most likely experience a price increase because lots of things depend on oil, especially certain businesses. Oil is important in basically everything. Um, so you have P star and P moving. I want you to think about how that impacts Q, how that impacts the current account, how that impacts aggregate demand, and also how that impacts the current account, the XX curve, right? So I will let you work on this together now. You guys can start drawing something, and we'll see how that goes. And then I'll provide guidance maybe in a few minutes. Only one monitor is working. Interesting. Okay. Both projectors not working. One of the projectors not working. Yes. Oops. Oh, I'm sorry. Okay. There. Okay, it looks like it's a disaster. All right, you guys can see that, right? All right, cool. Let's just work together. I'll start working. You can type questions you don't know. So I'm gonna whoever drew this, I'm deleting that. All right. We're plotting E versus Y. You can type questions on the side if you have questions, all right? Or if you want to raise your hand and ask me questions. That's ideal, but if not, then whatever. Let's see. Let's write DD and AA. Okay. All right. It looks like we're not mature enough to do this, okay? In that case, I'm just gonna do it alone. All right. DD and AA. So the question. Let me do it on the other platform. Sorry. I think it's not this one. Do it on this one. Okay. So go back to this. All righty. AA and DD. And let me write E versus Y. And I told you this P star over P is changing, right? So we're going to assume the following. Assume that domestic is USA and foreign is Iceland. Okay. Which means that P is going to be the US, and if there's an oil shock, the change in P is going to be much higher than P star, which means this value is actually going to decrease. Agree? So we know the real exchange rate is the driver of exports and imports. EP star over P is going to, of course, decrease. So if we look at our aggregate demand function, Y equals D. Let's just write it out just to be absolutely clear what's going on. Y minus T and Q, right? And we have one more curve, I forgot to write. It's this one. Okay. This is XX. Let's write the XX equation. CA called target, T for target. And we know that CA is a function of disposable income in Q. All right, so given that Q is decreasing, let's look at the aggregate demand function, Q decreasing, which means that current account is decreasing, which means Y has to move in a direction that elevates the current account such that equilibrium is restored. And we know that disposable income has a negative effect on CA, so we should expect Y to decrease and this to decrease, right? So that we get parity. So we should expect the DD curve to shift away towards the origin. Let's call it this way, say here. I'm trying to intersect that point there. All right, let's call it DD prime. Why not? That's why. Right. Yes. And but of course the equilibrium point is here. All right, the way to think about this, of course, right? Q is decreasing, but E is held constant, right? So we have to move Y, assuming that we hold E constant, which is why I pointed out to this point here, right? I'm holding E the same. Q is decreasing, current account must decrease as a result, which means that the DD curve has to shift towards the origin because Y must decrease in order for the current account to undo the change in Q, right? That's why the DD curve shifts to the left. Now the XX curve, I hope it's when I explain this is clear. It's the same idea. We hold E constant, but Q is decreasing, but Y has to move in a direction that undoes this decrease, and Y therefore has to go down, right? And in fact, it has to go down by the same amount as this equation here. Is that obvious? So let me recap. We have this equation here. We're analyzing the decrease in Q and its impact on Y. But note that in the Q, I didn't change E. So E is held constant, which is why I drew this dotted line here, right? So this is E naught. So given that E is constant, Q is decreasing, current account therefore has to decrease, and therefore Y on this side and in this equation has to decrease together so that the decreasing, its effects, the Q's effects on the current account is undone, right? That's basically what you're seeing. So therefore, Y has to move negative direction, which means DD curve shifts to the left by some amount. Let's call that difference, delta Y, right? From Y prime to Y naught. For the current account target, we see the same changes. E is held constant, but Q is decreasing, which means the current account is also decreasing, which will violate this target equation, right? This equality. To restore this equality, we need to change Y such that the equal sign is back, and that's only true if Y decreases as well. So in fact, the XX curve also has to shift to the right by the same amount. So this is XX prime. So I'm doing it this way because to show you where the new equilibrium is relative to the new target line because of this price change. So let me show you the question again. Your job is to compare oil-reliant country, US, to oil-independent country, Iceland. And the reason why this information is important because price changes is going to be different between these two countries due to the oil shock, right? If oil price is a big component of the consumption basket of the US, then you should expect all of its prices on average to be somewhat higher. Iceland, on the other hand, as we know, thermal energy, geothermal energy doesn't rely on oil, and therefore you should expect their price change to be negligible. And so we should expect in the short run that P star over P to decrease, right, in the short run. And our task was so there's something here that's hidden, so I apologize. So this says delta P US is greater than delta P IS meaning Iceland. All right, so our job is to forecast the impact on FX rates and the current account targeting policy. Yes, so let's take a look. We do see that the exchange rate depreciates, right? The US dollar depreciates because output declines, right? Output declines. But we are not hitting the target. In fact, we are hitting somewhere below the target because the XX curve has also shifted to the left, right? But not high enough, right? This increase is not high enough. So if one wants to hit this target, well, there's many ways to do that. You can try to change DD, right? You can try to change DD again, DD prime to DD double prime to somewhere, or you can change AA. So I didn't ask you that, but that's something, that's an extension you could potentially have to answer, right, for this type of question. Okay, so this is an example where the XX curve changes. That's all I wanted to tell you, right? And I want you therefore to be prepared on the final exam to perhaps manipulate the XX curve due to some change that I come up with, right? So in this case, I chose prices, right? Because of this news article I read, but I could easily say something else, right? All right. Comments, questions on oil price shock. So this is important because this has also recently happened because Iran sent a bunch of missiles to Israel. So another oil shock, right? Um, everything is relevant, okay, and macro. Okay, so the next question I have for you is called butterfly spread. So maybe you saw this in your other class, but this is another just an exercise to show me that you understand how to pinpoint precisely the kind of risk you want to be exposed to. This is called a butterfly spread because the payoff function looks like a butterfly to some people. All right, but essentially this is a bet. This is an option portfolio that bets that the underlying asset price, foreign currency price, doesn't change much from now until maturity. So I'll show you what the picture looks like. I'll draw a picture and then you can confirm. So let me tell you the setting and the instructions I give you in the setting. Suppose each call option is for 1 Chinese yuan. All right, so the underlying asset is just 1 unit currency of the Chinese yuan. And therefore, the delivery or when you exercise the option is the delivery or the sale or the purchase of that 1 unit of currency. The spot rate is 1.11 Hong Kong dollars. So 1.11 buys 1 Chinese yuan. So your job is to construct the following portfolio. You're supposed to long 1 call option with the following strike. I know the strike price is exaggerated. This probably doesn't exist, but I just added 1 and subtracted 1 to make the setting easier to work with. Okay. So going long 1 call option with a strike of 0.11 Hong Kong dollars. Short 2 option with the strike price of 1.11 or at the money. And then long 1 call option with a strike of 2.11. So all I'm doing is taking 1.11, which is spot rate, subtracting 1 and plus 1 for the strike price. And all I want you to do is construct a payoff table and then draw a graph. So let's do that together. This requires a table. So let me get a table. There's 1, 2, 3, 4, 5, 6 columns. Oops. Let me move it. Cool. 2, 3. All right. And 1, 2, 3, 4, 5. 1, 2, 3, 4, 5. Position, payoff today. And then I'm going to iterate over every single state of the world, right? Depending on what, between which strikes the final underlying price ends up to be at maturity time. So it's possible that, I guess I have to do this. E less than equal to cool. All right, it's gonna be there. Then can I just copy this? Cool. Zero 0.11. 1.11. Great. And then the final one is whether or not the underlying asset is greater than the last strike price, right? All right, so columns 3, 4, 5, and 6 is just looking at where the final price is at maturity. It could be below the strike price of 0.11, could be between 0.11 and 1.11, could be between 1.11 and 2.11, or could exceed 2.11, right? Those are all the possible states of the world, right? So I have a long one call, right, at k equals 0.11. So let me double check. That's exactly what we, sorry. Right. Long one call 0.11 strike price. So I'm just gonna write it all out. Short two call k equals 1.11. And then long one call 2.11 k equals payoff today minus C k equals 0.11 because I'm buying it. Shorting means I'm selling it. So 2 C k equals 1.11 at the money. And one long call, which means I'm buying it. So it's minus 0.11. I didn't tell you the prices, but if the problem gives you prices, then you can calculate, shifting the payoff by a certain amount. All right, so let's go through each call option and see whether or not it's in the money and whether or not it's exercised. So with the call option with a low strike price, if the underlying asset falls below this strike, it would never be exercised. So it's 0. If it's above the strike price of 0.11, then you will get E minus T times I minus 0.11 all the way through, right? That's the payoff. For the short two call option, it would only, again, be exercised by somebody if the underlying asset exceeds 1.11. So nothing would ever happen otherwise. But when it's exceeding the strike, you have to honor the counterparty that you sold the call options. So that's why it's a minus 2 ET minus 1.11 instead of plus, right? And it's the same all the way through. And finally, long call option with a high strike price. That means you would never exercise it for most of the states except the last one, which is ET minus 2.11. Okay, so total. So I'm going to skip this one because sum above. It would be 0. This one would be ET minus 0.11. And this one would be 2.11 minus ET. And then if you look carefully, all the ETs cancel out. This ET plus this ET is 2ET minus 2ET goes away. Adding these numbers, you will get 2 times 1.11, which is 2.22. So the minus and minus cancels out with that negative 2.22, right? And positive 2.22. So you get 0 here too. All right. So if I ask you a question to analyze the payoff, this is what I expect to see. If I ask you to draw it, I'm just going to draw it quickly with no markings, but I could ask you to mark. Just know it would look something like this. So this is probably, the strike price of 0.11, and this is the strike price of 0.11. It should look something like this, right? Yeah, right. It looks, I don't know if it looks like a butterfly, but certainly you're betting that the price doesn't move. So this point here, this peak, is at the money. That's 1.11. So you're betting that the underlying price doesn't move much, right? Around 1.11. if you factor in this amount, it definitely should be shifting down, right? Because otherwise it looks like you're getting something from, right? It looks like you can, it's a free lottery otherwise, right? Free lottery must cost something. I mean, any lottery must cost something. So the entire curve will shift down, whatever that cost should be, right? So in other words, with this additional cost, you're actually betting even more so that the price doesn't change, right? Comments, questions on option portfolios of such design. So the next question, of course, is also an option portfolio, but I'll give you some context, some context why you would ever execute such a thing. So if you've been reading the news, you should realize that U.S. intelligence knew about Iran's attack on Israel a long time ago. In fact, they gave out a warning to everybody saying that they're going to do it, right? And if you were a smart trader, you might have done the following. You might have tried to exploit the fact that the Israeli currency might swing wildly during this time period, right? So in other words, what you could have done is you could have tried to go long volatility. In other words, design a portfolio of options such that you'll make money whether or not the currency drops some amount or increases by some amount. So it's kind of like the inverse of the butterfly, right? It's the opposite. You're betting that the currency doesn't stay at its current value. You're expecting the currency to swing, and ideally by the time the options matures. So given this news, you might consider so-called going long volatility to exploit geopolitical activity in the Middle East. And I'm asking you to analyze the payoff structure of the following strategy. You long two types of options, one call option at the money and one put option at the money strike, okay? And again, just like the other question, we're assuming that the underlying asset quantity is just 1 unit of the Israeli currency, and they all have the same expiration date. All right, so recap: long one call, long one put, everything at the money strikes. So let's go ahead and do the payoff table. And this is 0.08 because that's at the money. So let me show you again that the spot price is 2.08. Okay, 2.08 is the spot price. And 2.08 is less than, sorry, it's E is greater than 2.08. You one long call, you one long put at the money. So K equals 2.08. You long one put. K equals 2.08. Sorry, this is payoff today, not table. So because you're long in both situations, it's going to be a minus. So minus, this is minus P. All right. If you're long and the strike price is 2.08, you would never exercise if it's below the strike. Otherwise, you get the difference. If it's a put, it's the reverse, right? So it's 2.08 minus ET, otherwise 0. So the total is not interesting, but maybe the graph is more informative, what it looks like. So if we were to do a graph, imagine this is 2.08, then the position would look like this. Okay, and if we were to account for the cost, we would shift the payoff down here. So you can see now why it's the inverse, right? It's the inverse of a butterfly because you're hoping that the price of the underlying currency swings either left or right of this at the money strike. And usually at the money options are quite expensive. So which is why, it's also a quite risky bet. But we've pinpointed the risk we want to be exposed to. We're okay with this cost upfront because we want to be exposed precisely to this possibility, right? We have some feeling, or your investment manager wants you to do this. This is how you get exposed to volatility. Comments, questions? So expect context followed by suggestion on how to construct portfolio. If you were to analyze such a portfolio, you do a table and a graph. And you just have to be careful about labeling the axes. So here, the only relevant point here is 2.08, but of course, if I gave you the price, you would shift it by the cost, right? So that is 3 questions, right? 1, 2, 3. Fourth question is a spin on the triangular arbitrage. So let me give you the setting. I give you a set of quotes, but instead of a trader, you are the market maker. And your job is to give a direct quote between two currencies in which triangular arbitrage is not possible. That's what you have to do. Okay, you have to give a bid and ask quote for a direct quote, ensuring that no triangular arbitrage is possible, and you have to also ensure that the bid-ask spread is roughly 0.05%, which is defined as this. Okay, so the difference in bid and ask spread divided by the ask multiplied by 100 has to be around 0.05%. So you can kind of guess what you have to do, right? You have to go through, remember how to identify arbitrage for triangular arbitrage? You have to go through at least 2 sequences, right? What you do here is you have to go through both of those sequences to give you 2 conditions. And given those 2 conditions, you can therefore define an inequality for both the bid and ask prices, right? That's how you approach this question. You need to go through the chain of calculations to derive arbitrage for those 2 possible sequences, and then come up with inequalities that put constraints on what bid and ask price should be for the direct quote. The price of Canadian dollars in terms of Japanese yen, right? And you have to make sure, and then you have to make sure you're choosing bid and ask spread such that the bid ask percentage spread is around 0.05%. All right, so let's do it together. So maybe let's see if we can copy this. Oh, maybe there's a print screen button. Okay, let's just take this so that we have reference. Wow, yeah, cool. All right, so let me tell you those two sequences I'm gonna try. I'm gonna construct the following trading sequences. Right. So you can see the two different types of triangular trading strategies, right? All circling back to US dollars, but the difference is the order at which I convert US dollar back to itself, whether I go through Japanese yen first, or whether or not I go through Canadian dollar first. So I can write out the mathematical algebra that I would have to compute in order to determine whether or not I get more than what I started. So suppose I borrow $1 and I go through the sequence of logic. Do I spit out more money than I borrowed? So the math would look like this. I have to solve for $1 Canadian per ask JPY, right? That's what I have to solve. And then I have to multiply 1 USD divided by, all right, let me use tech. One, 80. This is JPY. There, it's clear now. And then $1 ask JPY. Then USD 0.9187 dollars less than 1. You hopefully that's clear, right? So I'm taking that $1 and then I'm converting it to Japanese yen, right? That's what I'm doing, US dollar to Japanese yen. If I'm converting the Japanese yen, that means I'm buying, sorry, I'm selling at a lower price. So that's why it's 119.8. And then I have to convert to Canadian dollars. Right, this is what this point here. So I'm solving for this, right? I'm solving for this. So I can rearrange everything such that you just convince yourself that this is true. 1.130.4 is less than ask. That's the condition that you have to find. But the other one you have to solve for bid. Has to be less than 1. Right. Well, technically less than equal to 1. But anyways. Solve for this. Right? Because it's per Canadian dollars. That's what we're looking for, is the exchange rate between Canadian dollars and Japanese yen. And you should get bid is less than 130.51, roughly speaking. So a possible solution would be to set bid at 130.4 and an ask at 130.46. And that will give you a bid ask percentage spread of about 0.05. It's about, okay, around, you can round. Just double check, but you get the idea, right? You go through the sequence of buys and sells for bid ask quotes to find out if starting from one yields more than one. The condition, of course, is less than one to make sure that triangular arbitrage is impossible. So you make sure that both scenarios are impossible and you solve for conditions that must be true so that triangular arbitrage is not possible. So, and then you choose, you choose prices that satisfy that, and then you double check that indeed the bid ask percentage spread is roughly 0.05%. All right, so those are types of FX determination question I could ask you. So be prepared. I didn't give you, I don't think I gave you CIP in this set of sample slides, but you've done it in the midterm, so you can do it again in the final. It's possible. All right, export demand shock. So this question was inspired by the following news article. Janet Yellen's warning to China and economic overcapacity. So this is Janet Yellen complaining that China is spending too much government spending and subsidies, and then therefore dumping their goods and services at low prices in other countries to destroy the competition. People are not happy about this, and it's gonna obviously put a negative stigma on China, and so it's possible China suffers a negative demand shock for its export goods as a result of what they're doing, right? So my question for you here is, what effects does this have on the current account and output in the short term? And then I ask you to consider the People's Bank of China to conduct a temporary monetary intervention to restore output. And then you should explain why there should be a contractionary or expansionary, and whether or not the current account attains its target level. Current account target level. All right. So key idea here is the current account function maybe is different than before, and therefore output is hurt. So I didn't tell you where the source of it's coming from. So it could just be a generic change in exports, right? So CA is just a function now that's different than before, and therefore lower output. So I guess do the graph. A, E. So we know this, right? I, G, and then you can just say CA here, right? Okay, Q. So what's happening is this is being undermined, right? there's a fundamental change in people's preferences across everywhere else. People look at China as I guess, anti-competitive, right? And so demand for its goods and services is just fundamentally different than before. Demand is therefore lower, and as a result, Y has to respond, right, to equilibrate, and therefore we expect Y to decrease given that the current account function is just different now. What does that look like? It looks like a leftward shift of the DD schedule. Right. So I could ask you to explain a little bit why the final equilibrium point is up here. Right, the logic is with lower Y, something happens to the money market equilibrium. So anyways, I don't want to walk, so fine, let me just go through really quickly. Income goes down, lower income means that inequality here is therefore distorted, right? It's like this, that's no good. So something has to change to increase L, and that's only possible if interest rates go down, right? Interest rates go down only if E goes up, right? So E has to increase, therefore E increases. And this is all driven by the fact that carry traders, etc., maximizing expected returns, and therefore you end up here. Yeah. So I mean, this increase in E will increase Q and cycle, right? Feedback. And anyways. All right. So the current account target, I didn't draw, so let me draw it now. Does the current account target change? I didn't, you can say it changed. You can say it did not. Yeah, you can say it did not. So let's assume it didn't change. Then the final output is just, I mean, the final conclusion is that you have a depreciated domestic currency, lower output, and you're above the current account target. Okay. If it did change, well, I think so. If it did change, okay, this is lower. Let's hold E. Let's hold E constant, and therefore Y has to decrease. So maybe it's here. Anyways, it's still below, right? So the way I figure that out is drawing this, using this vertical, using this E line, right? I'm assuming that DD schedule shift this way. So I'm also assuming that current account target also shifted by that amount. All right, so how do we accomplish, how do we hit shift? Okay, I see. So your job is to restore this, right? But we're here. So the most obvious solution is to hit this point here, right? To restore. And the most obvious solution is to expand money supply. And of course, you're not going to hit the target, right? You're not going to hit the target. We're still above the target. All right, recap. The question asks you to analyze export demand shock. We're assuming that everyone's preferences suddenly change, and therefore the current account function across the globe is different now, and everybody just wants to avoid Chinese goods and services. And your job is to analyze the output effect of this change in preferences, this negative change in preferences on the XX curve and the DD curve, right? Because that's where the current account function appears. Here we see the DD curve has to shift to the left because the entire left-hand side of the aggregate demand equilibrium equation has been lowered, right? The left-hand side is decreasing, then the right-hand side has to follow suit. So that's why you get a leftward shift in the DD schedule, assuming that E stays constant, right? For the XX schedule, if we have current account also decreasing, let's hold E constant, then we know that Y has to move by the same amount as the DD schedule moves, right? It has to mirror it. And we see that the XX schedule doesn't shift that much in our picture. In fact, it will always be lower no matter how you draw it, below the new equilibrium point, right? So you'll always exceed the current account target. The second part of the question asks you to give the PBOC some suggestions on how to rectify this output decrease. And the most obvious way to rectify it, that is increasing output back to Y naught, is to conduct expansionary monetary policy, right? You increase money supply, lower interest rates, spot rate, domestic currency depreciates, output increases, etc. Comments, questions? So another problem that you could review, I mean, it's reviewing how to shift XX curves, how to shift DD curves, shift A curves. The formula is the same. I'm just reading the news and then trying to use the model to fit, the narrative in the story, and then try to make some predictions. This is what economic and finance news, how economics and finance news is basically analyzed. Very simple, right? Alrighty. FX swap valuation. So swaps are a type of side bet or derivatives, which is it's considered a derivative because engaging in a swap costs you nothing in the beginning. So in this setting, I'm giving you a 4-year currency swap agreement, and your job is to value it from the side of the US dollar. Okay, so it's a US dollar swap with euros. There's a notional amount of $10 million, and I give you the spot rate of $1.23 per euro. And I also give you some interest rates. So this class, when we value swaps, we keep things simple. We're not going to assume there's default, and if there's a change in exchange rates, we're assuming the exchange rates persists from the change all the way to maturity. So makes our lives simpler. So in this setting, we're assuming that at the 2-year mark, the spot FX rate changes to 1.25. So that means there's only 2 more cash flows, right? Before the end of the contract. So my question to you is, what is the value of this FX swap contract? I forgot to add after 2 years. Okay, so I forgot to say after 2 years. All right. Let me type out the prompt so I know exactly what I'm working with. 10 million notional, 10 million US dollar notional, which is equal to 8.13 million euro. Right. The reason why we do this conversion is because this is the amount we multiply the interest rates by to get how much to swap every period, right? So step 1, identify the notional amount.
convert the notional amount to the proper currencies, and then multiply the interest rate to get what's the amount that's being swapped every period. So 1% times 10 million USD is 0.1 million USD. 2%, 8.13 million euros times 2% is 0.163 million euros. So that's the amount that's exchanged every year for 4 years. However, everything else stays the same after 2 years. So 1% USD deposits and 2% euro deposits. So that number doesn't change. What has changed is the exchange rate, right? So if you tried calculating the legs, I think you should know the answer. I won't write out the DCF, but just trust me that the value of the USD bond is still 10 million because interest rates haven't changed. And the value of the euro bond is still 8.13 million. The difference now is the fact that we have to convert everything to the same currency after 2 years. After 2 years. So the price of euro leg, so price of euro leg. So we find out that the euro leg is worth more, right? So the price of the euro leg is 8.13 million euro times 1.25 minus 10 million USD. Right. The reason because let me write this out. FX euro USD changed from 1.23 to 1.25, which means that the dollar got weaker, right? Which means that the euro leg has value now beyond zero. In fact, it has a value of 0.1626 million USD. All right, so that's how you do the question. This is a very simple question, but again, it's not supposed to be hard. It's just for you to show me that you understand how to value swaps like bonds. Other things that could change are the time to maturity of these swaps, right? That's one thing that could change. I mean, could be different on the exam. The other possible difference is that interest rates could also change, in which case these numbers could change, right? It's no longer 10 and 8 like before, right? 10 and 8. It could be some other number if the interest rate changed. All right, comments, questions, swap valuation. So again, it's just swaps in this class. We think about it as pricing bonds, and we're going to keep the term structure flat, so you don't have to think about differences in discount rates across different periods of time. We don't have to think about exchange rates fluctuating over different periods of time. We're just saying that if it does change, it's going to persist until maturity. So these are things to keep in mind when you do the calculations in the exam. All right, one last question before we take a break. So crypto facts. So these are the kind of questions I could ask you. So you notice that I didn't ask you any complicated math questions or technical questions about wallets or anything like that. Private key or public key, none of that stuff. So let me read to you these 3 questions, and then I'll explain to you why the answers are why they are what they are. A government decides it will tokenize. So maybe there was a typo. It decides it will I think it should be digitized. Private vehicle registrations. If the province's auto insurance companies can record and maintain ownership titles using distributive ledger technology. So it basically wants vehicle registrations to be put on a blockchain. All right. This application of distributed ledger technology is best characterized as which of the following: A, blockchain; B, tokenization; or C, smart contract. So I kind of already told you what the answer is. If the answer is B, tokenization. Tokenization is trying to take something of the real world and trying to digitize it. So while it is a blockchain, that's indisputable, but it's something more than just that, right? We can say a little bit more precise. So tokenization, again, is trying to take tangible real world things and try to make it and try to digitize it and try to make that information unique and immutable, etc. It's not smart contracts, but it could if you have, for example, permissions to change the information. So Bitcoin, for example, does have some degree of smart contracts. For example, if you want two people to use a wallet, then two sets of private keys needs to be available before a transaction can be valid or can be created, right? So no, it's not necessarily smart contract, but certainly I believe the most accurate characterization of what's going on here is tokenization. Okay. So that's the first question. Second question: investors in an initial coin offering or ICOs typically receive which of the following: voting rights in the ICO issuer, B, cryptocurrency, or C, registered securities. So registered securities means there's government involvement, and that's not at all the case that we saw in 2017. So it's definitely not C. Voting rights in the ICO issuer, definitely no. That's the last thing what owners of businesses want to do, is to disperse their power or control over the company. Okay. Which is why, for example, Mark Zuckerberg, despite owning less than 50% of the shares, he has special shares that grants him basically control rights over the company. You want control rights, and ICOs or ICO tokens don't give you that. So the answer is definitely B, right? Given those other two options are wrong. Okay, it's cryptocurrency. They call it sometimes utility token. Like you can exchange that for some services or in the future or whatever. But it turns out to be all a lie as far as I can tell. Most of it, maybe 99%. Okay. All right. Lastly, what is a blockchain / distributed ledger technology that can eliminate intermediaries in transactions? So if you want to eliminate intermediaries, you need a proof of something, right? Proof of work, right? A consensus algorithm. And the consensus algorithm that you learned from last week was proof of work, which is the rule that everyone has to abide by to determine what is the correct, right? The correct chain, the correct ledger. So smart contracts doesn't eliminate intermediaries. Okay, smart contracts just means it's code that's executed on the blockchain. Tokenization doesn't, as again, it's a generic term. It says nothing about eliminating intermediaries. And so the answer has to be A, cryptocurrency. So cryptography is the foundation in which you can decentralize the information, right? That's the only way to do it. You have to have a proof of work or proof of some protocol, right? Some consensus protocol, which is very expensive, right? It could be proof of work, could be proof of something else. But that's the idea. You have to make it expensive to validate transactions, right? And that's done through cryptography. All right, comments, questions on this? So expect something like this. Could be multiple choice, could be true, false. If it's true, false, you have to explain why it's false. That's it. Just basic understanding of what cryptocurrencies are, blockchains, whatever. All right, let's take a 10-minute break and then we'll finish the last few questions afterwards. Oh,
I still don't understand the AED's XF graph very clearly. So the target, what is the target? The target is
it's the equation.
Yeah.
It's the equation.
So the target should be the income Y.
It's the target is a number that the country has decided should be like its export
Export.
goal. Yeah, so we assume that in the beginning, the country has achieved its export goal, and then there's some change that occurred that,
Yes.
yeah.
For example, at first the DD curve shifted to the left to this point. At first.
So if you hold E constant, it shifts
Yeah,
here, but of course,
E naught
Yeah,
round
yeah,
and
yeah,
then to
yeah.
the in prime.
yeah,
So this point and the XS shifted to the XS prime.
yes. But again, it's shifting to the left by the same amount because this is the same, right? This is the same,
Oh,
right? You see? So I wrote it down explicitly to explain, to show you, right? Yeah. If there's a changing Q that's changing, then Y has to change, but Y appears on both sides, so it has to move. Yeah, everything has to be consistent. Here, same thing. If Q changes, C changes, but Y has to move to undo the change in Q.
Yeah.
That's gonna be it's the same change in Y, right?
That's why.
That's why I highlighted this gap here. Like
Yeah. The Y prime and
Yeah.
Y double prime.
Yeah.
At first the Y not to the Y prime, and then because of the Y decrease, so
Yeah.
the current account
Yeah.
will undo the
Yeah.
effect. The
Yeah,
effect
undo the
the,
of Q.
the Q.
Yeah.
Yeah. So will change from Y prime to Y double prime.
I mean, this is tell you how to shift the curves. The equilibrium is here.
Yeah.
Yeah. Yeah.
And then the
But that tells you the relative to the target though. Because
Yeah.
higher is always more higher current account. So you're over your current account, right? You're beyond your current account level.
Oh.
Yeah.
What do you mean beyond?
This at this level, the current account level is higher than CA underscore T.
Understand.
Because you're not on it anymore. On it means it's equal, but it's not. You're at a combination of E and Y that gives you a CA that's greater.
So
This point has a combination of C and Y that exceeds CA over T. So every point on this line gives you is a combination of E and Y that gives you a current account that's equal to that.
targets.
Yes, but this combination of E and Y is not on this line. All right,
Which E and Y?
this E prime and Y double prime
Oh.
is not on the line.
Yeah.
So it's not equal to that.
Yeah.
And higher E for a given Y will give you something more, right? Because if you want it to be on this line, it should be that point right there, right? That.
Yeah.
But it's not.
Because E is higher, so the current account will be higher than the target. Yeah. That's correct. So, and next question is how we change the AA or DD curve to achieve the target.
It's,
But
there's
for example,
could be more than one answer, I don't know. So for this question,
yeah, yeah.
I don't know.
To achieve the y,
know.
y,
But do you want this again?
yeah.
I guess you would have to shift the, oh, you want to hit the target.
Okay,
You wanna hit the
yeah,
target?
Yeah,
Oh, I don't know.
yeah.
You have to be creative. I don't think I'll ask you to do that. Yeah, I don't think I'll ask you to do that. Because it's complicated, right? You have to move both A and B,
Because I
right?
remember you talked to
Just-
the
Can we just let move AA to the left and then we?
Yeah, but then if you do that, then you have a negative output, right? I mean, you want, so you want to hit the target and also be positive output, and
Okay.
yeah, there's too many conditions here. So here, yeah. So I probably won't ask you.
I remember
yeah.
you talked that we it's impossible to hit that point.
I mean, you can, but you're gonna be above the target, right?
Oh,
Right, that's the
right,
point.
Right.
So I think the question I ask you, I didn't ask you to, I didn't ask you to find a solution. I think I just told you where you're asking. Yeah, does the current account attain its target? I just, that's all I asked. You.
Okay,
That's
okay.
it.
I mean,
You just
Oh.
tell me it's above or below the target.
oh.
That's it.
And another question is about. Oh, so the answer for this question should be the only, or it just a range, and we just.
I won't ask you this question because I already gave you this as a sample question, but you can imagine I can ask you like, just, this is asking the same question in a different way, right? It's just,
Oh,
it's
possible
just,
solution.
it's just
I-
triangular arbitrage.
understand.
So, yeah.
Why is ask because the GPY is base currents. So I think it's.
Oh, so I think I'm starting with USD instead of
Yes.
Japanese Ys. So
Oh.
yeah.
Uh-huh.
you don't have to start with USD. You can start with something else. So in this way, in this example, I start with USD.
No, I want to ask why there is not bid price? Because we sell GPY and buy CAD.
You're trying to
Uh,
get CAD with GPY, and you need to.
So you will.
Oh,
you
hold
need
on.
to sell JPY and JPY. So you need to close the.
Okay, maybe I reversed it.
Yes.
No.
Hmm?
Did I reverse it?
Really?
Because GPY is the base currency.
So I borrow one USD. I sell it.
yeah.
I'm selling it. I borrow one USD and I sell it for
GPY.
yeah.
And
So sell.
Sell USD.
Yeah, selling for sell.
yeah, to ask it need to be
Oh,
above.
sorry. I think this is the confusion. Yeah, sorry.
Okay.
I wrote that as the typo, sorry. Yeah, now it makes sense. Yeah, sorry. Yeah. Now it makes sense, right? Because these are Japanese yen numbers, right?
Yeah.
Yeah,
These are
yeah, it makes sense now, yeah.
Mm.
Yeah. No. This, I'm not, this, yeah, should be reversed, right? Canadian dollars are weaker than dollars. Yeah. Yeah, sorry.
That means $1 by how the
The
number.
way I wrote it here says the price of Japanese yen in terms of dollars, but I'm looking at this and I just realized this is yen. So it should be the price of dollars in terms of yen.
Yeah.
Yeah.
That should be yen. So
Yes. So the yen should be the numerator.
Yeah, that means one USD equals to
yeah. So $1 for this yen.
yeah.
Oh,
That's-
I just realized this. This should also. Yeah.
That's wrong.
Yeah, the title's wrong.
Oh,
Sorry.
the title.
Sorry. Yeah. Sorry.
Still confusing about the XX line. Sorry, where's the question? Question.
Oh, the question.
Which one? So the first one. Here. The policy.
It's just asking you to tell me what happens to the XX curve. That's it. Because it also changes too. Right? Yes?
Oh, yeah.
That's all. You just describe, if you can show, this is just a generic instruction to just describe what happens to the XX curve.
So we just need to say, what's
Oh,
the
all right.
change of the x
The exam question is not gonna look like bullet point, okay? I will give you very precise instructions. This is just hand waving saying, tell me what happens to the graph, okay? Right, so, I forget which one is it. First question, right? Yeah.
Oh, yeah.
Yeah. Tell me what happens to the x curve. It does change, right? Because price ratio changes. And price ratios are there. So it does change. You just tell me, the question is asking you basically, what I was trying to ask you to tell me is just tell me what happens to the graph. So everything, tell me what changes, right? Okay. Anything that has P star and P changes. It's there, it's there.
Just the progress.
Yeah, and this is all short run stuff too, because it makes no sense to change prices, because I usually assume sticky prices otherwise, right? So this only makes sense in the short run context.
Okay.
Yeah,
Maybe
Is that-
after class will be better
that's okay.
because time is very valuable.
Is it okay? Sure. I think we'll finish early, but anyways.
I think, what's after that?
Okay, I guess there may be some questions from the case study from some people, so let's just finish the last few questions, which I think it'd be pretty fast. So we stopped at this one. So this one is also true or false questions. So just be aware, I can also ask you true, false, or multiple choice questions for, just economics or finance stuff. All right, two statements. The first statement, under a floating FX rate regime, a permanent nominal monetary expansion can only lead to an output response if the exchange rate overshoots simultaneously. So this is just basically describing week 3's result when we do permanent monetary expansion and analyze what happens to the exchange rate in the short run and long run, right? And we know that in fact is true if we assume that we have sticky prices, right? It's this combination of expectations changing with sticky prices that gives us this overshooting effect and therefore creates volatility in the exchange rate markets. So this one is true. I'm not gonna write it on the board. So first bullet point, true, okay, because but you can qualify saying yes if there's sticky prices, right? Because that's the assumption that gives us overshooting. Second bullet point, if assets are perfect substitutes, it is irrelevant whether central banks intervene in the open market with domestic or foreign assets. This one is also true, right? Because if assets are perfect substitutes, then rho is equal to 0. Remember the augmented adjusted UIP curve? The rho exists because countries have different risk profiles, right? And the rho is supposed to capture that difference, which is a function of privately held government sovereign debt. If domestic and foreign sovereign debt are comparable in risk, then the rho term is 0. So it doesn't matter if you conduct monetary policy with domestic or foreign assets. I spent some time, right, explaining to you that if you do have rho that's positive and you do expansionary policy with domestic assets, you will get competing effects on E, right, which is bad. You want E to depreciate with monetary expansion so that you get a large output effect. But if you do it with domestic assets, you're going to get competing effects. Doing it with foreign assets avoids the problem completely, right? So the answer is true. Okay, I'm sorry. The statement is true. All right. So building on top of that, Uncovered interest rate parity. I asked you to explain how central bank might intervene in money markets to lower the domestic nominal interest rate without changing the exchange rate. So this requires, right, changing rho, hopefully, and also changing money supply. We're hoping that changing money supply and changing rho will give us will allow us to maintain the exchange rate. So this is good, right? Because we want the competing effects now. We want monetary expansion and we want our currency to also strengthen so that we maintain that peg or that exchange rate. Is there a limit to how far the central bank can lower interest rates while maintaining the nominal exchange rate? Explain your answer. All right, so let's just go ahead and analyze the adjusted uncovered interest rate parity. So let's remind ourselves what that is. It is the simplified term, R equals R star plus rho, right? Which is a function of B total minus B CB, right? The amount of sovereign debt held by the government. I mean the central bank, right? So we can analyze the ability to maintain the peg using the T graph instead of the AA and DD schedule. So no need to go through the A. I think this is more compelling. So we can go ahead and do that. This is R, this is E, this is L. And this is R. So what we want to do is we want to lower R, so we want R to decrease, so that's monetary expansion. You know that looks like this. So let's just write MS over P, MS prime over P, and we lowered interest rates to R prime, but we don't want exchange rates to increase to this point here, which is, let's call it E prime. We don't want that. We want to maintain this, right? That's our goal, is to maintain that level. So we want the UIP to shift downward, right? So that it intersects precisely at this point here, right? We want UIP to shift down so that we end up here, right? So lower interest rates, maintain E at E naught. And that's only possible if this term is non-zero, right? So what we want to do, therefore, is to find some way to strengthen E, right? So we want E to decrease. So that's only if it's like this. So we want to distort UIP such that this entire term is lower, and that can be done by increasing this, right? So if you conduct your monetary expansion by buying domestic assets, that could decrease this entire expression, which will decrease rho, right? Which will lead to this inequality, which forces us to decrease E, right? To increase it back to parity. So that's how you get the downward shift. So takeaway, conclusion here. Monetary expansion. Monetary expansion via purchasing domestic assets, right? Will give you exactly what we want, right? We want E naught to be the same, and we want interest rates to drop. All right, the question that we still need to answer is there a limit to how far the central bank can lower interest rates while maintaining the nominal exchange rate? Of course, right? Because if we don't have domestic assets to buy, then we can't do this, right? Limitation. We need privately held domestic assets to yes, to buy, right? If there's no more privately held assets, then you can't do this. So let me recap. This is trying to understand how to use the adjusted uncovered interest rate parity so that we can keep the exchange rate the same while decreasing interest rates. So we looked at the tilted T graph where we're plotting E versus R versus L, and we draw out the path of the curves so that interest rates are lower, and also E naught maintains the same. And we came to the conclusion that we can decrease R by increasing MS, right? Increasing money supply. But in order to maintain E at E naught, we need to somehow shift the UIP curve downward. And this requires us to assume that there is a rho term that's non-zero and it's increasing as a function of domestically held sovereign debt. Sorry, privately held sovereign debt. And we find that if the central bank conducts expansionary monetary policy through the purchase of domestic bonds, that would lead to a decrease in rho and therefore a decrease in E, which will allow us to maintain E naught in conjunction with expansionary monetary policy or increasing money supply. The limitation, of course, is that we need to have things to buy, right? You need to have domestic assets to be bought. If you don't have any, then you can't do this. All right. All right, so this is just forecasting with the Fisher effect, or the decomposition of nominal into real and inflationary parts. So here let me read you the prompt. We have Hong Kong dollar fixed to US dollars. If price level in the US rises slower because of slower monetary growth in the US, explain how the HKMA, or the Hong Kong Monetary Authority, have to respond in the absence of any other government intervention. So of course, having the Hong Kong dollar pegged to the US dollar has constraints. And if inflation or money supply growth is slowing down, then Hong Kong Monetary Authority has to do something in order to maintain that peg. So let's go ahead and write down what we know, right? So we know that HKD pegged to USD, which means that according to UIP, E is 0, which tells us that R equals R star, right? Oh, sorry, equal. All right, so using the Fisher effect that you learned from macro, that just tells us that real interest rates minus, let me use tech again. R equals lowercase r minus pi must equal R star R R star minus pi star, right? Great. All right. So we know this, right? And we are told that that's okay. Let's assume that Hong Kong dollars is domestic. So domestic. So if money supply, all else equal, of course. So let's assume that money demand hasn't changed, but money supply has changed, and therefore inflation has changed. Here it's lower, right? Then this entire expression has to be lower, which means that R therefore has to be lower. Maybe that's too simplistic, but that's the implication, right? If inflation is lower, which means that's lower, which means that R has to be lower, right? So HKMA has to somehow must increase money speed, money supply. We can say speed, shall we? So in other words, sorry, is it increase? Sorry, it's the other way, right? Decrease. Yeah. Okay, so we're not talking about long run stuff. Okay, so price level slower because of slower. Okay, sorry, no. I think the way I was thinking is the long run, we're talking about long run stuff. So in the long run, yes, we have a decrease. So okay, so this is fundamentally different than what you learned in like week 5, right? Week 5, we talked about floating exchange rates, and we talked about in the long run, we have the long-term condition if relative PPP holds. But for pegged exchange rates, it's a bit different. For pegged rates, this has to be true no matter what, right? R must be equal to R star. And if R and R star are defined in the long term as the difference between the speed R star and inflation is decomposed into money supply minus money demand, then therefore, in order to match that decreased speed, the HKMA has to match the speed as well, right? That's what it's saying. So you have to decrease money supply speed in Hong Kong to make sure that domestic R is equal to foreign R star. Yeah, so I'm using UYP, yes, and I'm using the Fisher effect to decompose the interest rates. And we find that in the long run, if Hong Kong wants to match the speed, must match the speed at which the pegged country's nominal interest rate changes. Okay. All right. So this is another UYP, adjusted UYP question. Assume there's a credit downgrade in Hong Kong. So this question was inspired by the following news. I think just within the last year. Hong Kong hits back at unfounded comments after ratings agency Moody's downgrades credit outlook over closer ties with mainland. So based on that news, some investors may interpret this as Hong Kong bonds now bearing greater risk than bonds in other countries. And your job is to explain how this credit downgrade ate Hong Kong's economy under floating FX rate regime, and explain how Hong Kong can maintain its peg if the peg is changed because of this announcement. So of course it's going to change because rho is now non-zero given this credit downgrade. So let me write, maybe I can just copy and paste this one. Cool. So what we have is this increasing, right? Rho is increasing, which means that inequality is like this. And so E has to move in a direction that restores parity, and that's only possible if E is larger than before, right? So we should expect depreciating forces on the Hong Kong dollar as a result. So let's look at AADD schedule if we want, although it's kind of excessive, we can. What that tells us is that the A schedule is going to shift upward, right? So upward shift of A schedule. And of course, that's a no-no under pegged exchange rate regimes, right? This cannot be. So what has to happen is that Hong Kong needs to conduct contractionary monetary policy to restore this peg, right? So maybe I drew this line poorly, but if AA wants to shift up because of rho, it has to shift back down by monetary contraction. So conclusion, if rho is positive now, E increases. HKMA must shrink money supply to maintain peg, right? Otherwise, the E is too depreciated. All right. Comments, questions on the adjusted UIP? So I gave you 2 questions, or actually more than 2 questions. I think also multiple choice question. Just making sure you understand what this term implies and what's a function of and how does it change, and if it does change, how does that impact which curve, right? You don't always have to. When I sometimes will tell you to analyze something that may not be specific which kind of graph to use. You may also try to use the T graph, right? E versus R, right? Which is also a good tool to communicate what you're trying to say. So you don't always have to plot E versus Y. All right, is this the last question? It is, okay. So we will end early, so in case you have questions. So this question is open-ended in the sense that I want you to come up with an explanation given what's being observed. So this is like the homework question I asked you, right? You observe some things and then you try to explain, rationalize it with the framework we have at hand. So here we have the following news article title, How the US-China Trade War is Delivering Big Wins for Mexico. So let me tell you what's going on recently is in response to the high tariffs implemented by the US on Chinese goods, there is a loophole, as obviously stated by the title here. The loophole is that rather than exporting directly to the US, what a lot of Chinese companies are doing, and also US firms that's operating in China, or doing business with China, they're moving their businesses to Mexico. And so in order to circumvent the tariffs, they're actually exporting to the US from China through Mexico. And so they basically bypass the 25% tariff that's been enforced. Okay, so Mexico is benefiting from this, but it's a bit paradoxical because we observe two things. We observe that the peso getting super duper strong, very, very strong against the dollar. But we also observe an output effect. So that's a bit contradictory, right? How does a strong currency lead to strong exports? Well, you have to quantify and compare the magnitudes of the competing effects, right? And so that's where the rationalization comes in. You have to explain to me, come up with a story that gives us this result. How does Mexico maintain an appreciated currency, but at the same time have becomes U.S.'s greatest trading partner, right, within the last year? All right, so let me read you the observations. You observe high foreign direct investments due to high interest rates in Mexico. Mexico has interest rates of 11.25%, and US has interest rate of around about 5.5% per annum. US tariffs on Chinese goods is 25%. And NAFTA tariffs, so NAFTA is the North American Free Trade Agreement. It's trade agreements between Canada, Mexico, and US. And it's only at 2.5%. Okay. Market expects Mexican peso to continue to appreciate. So what that says is that E is expected to decrease, assuming the domestic country is Mexico. Now your job is to explain why Mexican output is increasing despite stronger peso relative to USD using the AADD and XX schedule. So let's go ahead and try to think about what's going on using the graph. So first things first, I said there's this high FDI, so foreign direct investment that can go towards many things, but I think you should think about the following. FDI so the story, right? The story is that Chinese businesses, in order to build their manufacturing plants, have to pour a lot of investments into Mexico. And so lots of that FDI is going towards domestic investments. So you should expect that I increases. So assume domestic country is Mexico. High FDI implies that I increases. So we have I increasing. And I also mentioned high tariffs, right? High tariffs. So the way to think about this, so we're going to compare Mexico to foreign, so USA. All right. So with higher tariffs, Chinese tariffs, you can imagine that US prices on average, if one were to, I guess, you can imagine that US prices, US goods and services being sold is also a function, could take Chinese goods and services as inputs, and therefore prices could also elevate as a result of high tariffs from China, right? And so that could actually increase P star, right? So again, we're just coming up with a story here, right? That's the whole exercise. Tell me what's going on. So we have high FDI, lots of that foreign direct investment going to domestic investors because they had to build plants to manufacture cars, blah, blah. That's obviously going to affect output. High tariffs means that some businesses in the US who produce things using Chinese goods have to become more expensive. So you should expect prices of US goods to also slightly increase as a result of the trade war. All right, so that means that Q increases, right? Because Q equals EP star over P. And as a result, we should expect D to increase and D and Y to increase, right? Which means that DD curve shifts to the right, right? So say it shifts a lot. It shifts a lot, right? Because I'm talking about, let me explain why again. DD is a function of I, G, and Q, right? So we have I increasing a lot, and we have Q also potentially increasing by some amount, and therefore D increasing, and therefore Y has to increase, right? So, and so you can already see it makes sense already, right? And what's interesting, one final point, E hat E increases, sorry, decreases, right? Because expectations have changed. So AA schedule downward, right? So the competing effects comes from this, right? This one and these effects. So with AA shifting down because of E hat E decreasing, you can see that output somewhat dampened, but still you get a stronger currency, right? You still get a stronger currency. Sorry, it's this one. Right, this is E naught. And this we starting point here, and the final resting point probably maybe here. Right. So the story, how this is possible is because it's basically fiscal policy that's driving, right? I mean, or the thing that impacts the aggregate demand function is what's driving the output effect. And that's making the currency stronger. But the fact that people are expecting the Mexican peso to become even more stronger than before is actually hurting the output effects slightly, right? So it's amplifying the strengthening of the currency. But the fact that we see a positive output suggests that the shift in DD curve is much stronger than the shift in AA, right? The downward shift in. All right, so let me recap. Mexico, the story is again, stronger Mexican peso makes it ideal for FDI because they get 11.25% interest. All that money is going towards domestic investments, which increases I. Tariffs is making some US goods that's being consumed by Mexico perhaps more expensive than before. And therefore, we can interpret that as P star also increasing. And lastly, I said that market expects that the peso becomes stronger. So E hat E is decreasing, which will further decrease E through the downward shift of AA. So when we plot everything, it looks like this. So if we do observe positive output, that means that the downward shift of the AA curve is not completely crowding out the output effect from the the aggregate demand shift, right? So that's why Mexico is benefiting, right? He's essentially benefiting from this trade war between US and China. Cool. So comments, questions on, just translating information from the news and trying to put it into the framework I've tried so hard to force you to be experts at. And then now you know how the moving parts work, and now you can make robust predictions quickly without relying too much on the data. And I think that's what's most important is what you get out of this class. Okay, So I went through 12 questions, I believe. Was it 12? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Yep. So 12 questions. Of course, you noticed I skipped all that currency arbitrage. So those could be questions I could ask. Again, I didn't expect people to make mistakes from the midterm, but if I do give you that kind of question, it's basically a freebie, right? So anyways, the spectrum of questions I could ask is quite large, right? So in any case, that's all I have for you today. So so let me summarize what you learned. Hopefully the past 13 weeks, you learned a framework to understand how exchange rates are related to interest rates, prices, and international trade. So there's a nominal side, there's a financial side, and also there's a, hopefully I convinced you there's also a real side, and therefore requires us to understand macroeconomics a little bit deeper. Secondly, I learned because it's related to all these other things, such as interest rates and prices and trade, we know that these things are ultimately linked to central banks and government policy. And therefore, these two institutions can influence outputs and therefore exchange rates. And therefore, the current account, as we learned, is the nexus, right, that connects the real side, the real economy with the financial side. And the last third of this class, we learned about how to manage FX risks through derivatives, but I think that was mostly review for you guys, given your previous semester coursework. So I hope that you can draw on the tools that I presented to you. Hopefully you enjoyed or found it interesting, the monetary policy tool I gave to you last week about extracting reverse engineering probabilities from options. And I just hope that you have something to take away from this class. Congratulations. And if you have, I encourage you to fill out the TLQ if you haven't already. And of course, if you want me to, if there's something I can improve this course with, please let me know in the TLQ when you fill it out. All right. Thank you. And we're ending early. So if you have questions on the case study, I'm happy to answer them now. All right. It's the same format as midterm. Open book. Yeah.
Everyone is so nervous.
It's open book, open notes, just like the midterm. So, okay. I don't think you should be nervous. So, questions?
Yeah. It's about the assignment.
Okay.
Assignment. Yes. So,
That looks right. That looks right.
that were right. Okay. Because in this sheet, I make the Cuban rate or the labor. I make it floating according to this equation.
Yeah.
Okay. And another sheet, I make the labor rates is fixed. And then this is the equation.
I think you're backing out LIBOR, right?
Yeah. So, yeah. Yes, I use the interpolated yield rate.
Yeah.
Yeah, and this one I use the interpolated yield for 20 euros.
What?
So this one,
This one.
this one is
Yeah. This one.
okay.
we need to simulate the yield curve, and then we need to use the future.
You don't need to simulate, you just need to.
Now this is wrong.
那选完了，但是我不认为他选的对，
应该是这个。
What is your question? Yeah,
I just want to
Yes.
make sure.
it's not, what you did, that was wrong. This one looks right.
Yeah, this one's right.
I don't know, I don't remember the answer. Everyone that's gonna be different, but as long as the steps you take is correct.
So that may need to we need to simulate the curve by the rate given, and we use the 那个forward rate to
Yeah.
simulate the
Yeah, yeah, yeah. Correct.
这个 library 是定的吗？跟其他的
Yeah, you need to.
它就是那个两个给定的，然后推出来那个曲线，然后再有再给 lever 的话，推出来一个 lever。
Yeah.
So I
There should be. Three points or 4 points? I think we make those, right? If you don't use all the points, it's fine, but there should be.
远期
At least 3.
你有了设计曲线，你可以用远期
everyone
计算
is very
用的 future library。
that's why higher school.
Yeah.
然后给它当成二期的。
Okay. Yeah, yeah. It should be. The hard part is reading the case. The hard part is reading the case. The questions are actually using.
Yeah, yeah, yeah.
把和点定了之后，然后就每一期的
还有那个题嘛，还有那个
每一期的数都出来是吗？
我再确认一下。哎，其实有 curve 就会就是在那儿。
因为它相当于是两个点，一条线，这个线上面每过一个 period 的那个数能够出来，然后根据那个求每一期的 library 是多少，
四
这个意思吧？
有 curve，然后不是给你个 lever 的那个公式吗？然后你就能求来一个40期的 lever，然后你40期的 lever，40期的公式。
等会儿啊，我都忘了。
Yes.
I don't have animal.
What's okay? Yeah, that should be the most confusing part, but I think the hints I gave you should be super clear.
Yeah.
Yeah.
因为你是从第0期做到第20年吗？00年然后一直到20。
一个 curve，一个
它
curve，
就是一条直线，然后你就上面不断的取点，
给它
然后用那个点去求 library，
Yes.
每一期的 library。
对，你就是去做一个老师上节课讲过，你做一个 regression，但我们想明白那个 regression 用来干啥？很简单，你不是知道10年的是8.29吗？然后你又知道30年，
There's no regression.
just involve
Regression. This is NBA case studies.
OK。
No regression. NBA's can be.
然后对差值，
它值的意思其实就是连一条线，连条线然后对应
就找点儿，
对，然后你就得出到这个，
有的可
然后你再根据这个把它加上那两个，就是那个公
If,
然后
if you want to run a regression,
啊能
you can.
No, 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 no.
You can. You can.
No. Gentlemen, just get the same answer.
然后你就
Almost
往下再根据这个，然后
Because
有折线，
We only have
Okay.
one.
Well, if you,
然后都
I think you have 3, but let me see. You're right. Yeah, I guess so.
Yeah.
Yeah.
We have
Okay,
3.
yeah, you should, yeah.
道题
我们有一个20年的那个零息，然后我们有一个那个
14年的。
10和30年的那个代期。
Oh,
啊，对。
那就 OK 了。
泰西的息是多少？
这个其实是8.29和8.28。
不是，那是 Q 票吗？
快点到了，
那是 Q 票还是
不，
来着？
那是业务，
有。
那是业务。
I think it's political. I think it's political.
political. My question is why?
I think it's a reaction to the national security law. That's part of downgrade.
Why road is downward?
Oh, in that question.
Yeah, in that
No, it's upward.
upward.
It's upward. Because there's a premium. There's a premium to holding on to the bond. So
That's
the
because
bond,
it's a hard risk.
yeah, the bond itself is not enough. You need another term,
那个
make it worth returns to worth it.
啊，那个
balance.
credit 等会儿，不是，上到这11题吧。
Actually, I don't remember where is, in which chapter we talk about the road.
Adjust the UIP.
The last lecture, not the lecture before the risk management stuff.
就是货币衍生品那些之前的那个。
Yeah.
Okay.
Because we work with the ideal setting, right, where everything's perfect and there's no risk. That we talked about pegging and additional risk factors. That's some deviations from our ideal, right? That was the last lecture for risk management stuff.
Will we hold another officer in the next week or?
If you want, just let me know. Just let me know.
Right on letters.
Yeah, right, you know. Yeah,
我说的那个。
I think this class should be the least of your worries than the other classes, but
Yeah.
I think credit risks sounds fixed income. Yeah, fixed income should be hard.
That it totally goes to book with no cheat sheets.
I guess it's because it's
So it's about
I think it's theoretical, right? It's theoretical?
No,
No?
no,
So what is it? Simulations?
yeah,
Like-
and very technical.
Okay.
Just too many equations to remember and remember how to use that to solve the question. Okay. You need price every security.
哎，所以因为我们的逻辑是，等于说我们先求了那条直线，
对
然后用那条直线直接求那个lever，
Lever
对吧？然后那个
其实你求出 level 之后，下一步就是求那个 coupon rate。coupon rate。
对你有了 lever 之后，你
然后得到 coupon rate 之后，你又得到 coupon payment，就是每一次你要付多少。
我知道，
然后你得到 coupon payment 之后呢，然后我们又知道这个 interpolated yields，然后我们就用那个
折回去
对做那个 discount factor，
然后加起来。
对，然后再把 present value 再加起来就可以了。
之后我们要用那个20年的那个什么来折现，
对
对吧？
对，
好贵啊！
就是你假设了很多东西。
对啊，我感觉
哎，那个基础的 lever 用在哪里 ？So the 6 months lever rates
You can use it
you use it to what?
at the
Beginning.
beginning.
Oh,
Yeah, beginning.
但是我记
这
得
个
Yeah, you just use the curve to 那个 calculate the future level, but the first level is given.
Yeah,
Oh.
first time is good.
但是我没有用，
你怎么做出来的？会改。
用一点，
我直接就是
I mean, it doesn't matter. Like,
Yeah, I just
there's many ways to do it. So.
哦，我觉得我之前的那
如果你用直线上那个线程的，其实我感觉差距不会特别。
而且现在还是有的。我当时想到这个问题了，
是多少？他给了就反正就用上了。
你现在第一次有点问题，就是用你差值的那个 yield curve，然后去加嘛。
刚想问差多少？6.5差多少？
但那个0.85，那个85 BP 是放在哪儿？
你用10.674减去1.625，好像是个9左右。
减2.48，
对，
减2.4。
其实就是8.19加8.2加上一个0.85，9左右。
不是，如果你用这个直线直接计算那个 future level 的话，那你那个8.85 BP 用在哪儿？
就是
我加到那个，
我是加上了之后，它不是，其实和那个还是有差距的。
那加上了之后，那个呢？那个叫 level 吗？
应该是因为你们互换，所以是不是就可以等价这样看？
So we get the curve and we need to add 85 BP on this curve or not?
I don't remember. I don't know.
Beautiful.
The answer should be you decide. I think I given you enough.
Really?
Yes.
Yeah, here. That means the LIBOR obligation to the fixed rate obligation. The rate is
Yeah,
the
yeah,
same.
exactly the same.
Yeah.
Yeah.
那其实就是这俩，这个 LIBOR obligation is equal to fixed rate obligation. That means they have the same rate. So the LIBOR rate equals to the obligation of fixed rate.
所以就可以那个是为了385，那个是算 swap 的。
对，其实你就
其实啊，这是它那个所有的曲线是，那就是先加，然后再求那个 level。
OK，先加其实加上之后就是来，
不对，我说加上之后不是
再
你加
加
上之后你再求那
那
个
个就是
再求 forward 的就是你加上之后你再求 forward 的就是那个
再求
未
forward
就是未来的 library 嘛。你应该用 forward 的呀，6个月嘛，library 都是6个月嘛。
但是你那个差值差出来不都是6个月6个月6个月？
不是啊，
是啊，
不是你差值差出来是个07吗？不是，
什么07啊
不？是你差值差出来不应该是个
没有啊，你差值差出来是这个，
啊？
你
对吧
差值差出来这个加0.85，得出来是 library，
有两个差值，一个
没有2个差值，不是，
我指的你们是哪种？我就差不多，我现在好好。
不是，它就是连着那两个。
应该是8.29和8.48，
那这那差出来不是零系的吗？
但是它不是07的，
差出来是07的，是
它不是07的，差出来不是07。
不是对。